Hey, what's going on everybody? It's Blandon here from Mortgage HQ. It's that time of the year. You're getting the letter in your inbox and it's your bank sending a mortgage renewal letter. So what should you be doing to maximize your position to save money, utilize your equity, and pay off your mortgage sooner? Now, if you stay till the end, I'm going to share with you one of the biggest mistakes that I see homeowners make up on their mortgage renewal as well. Here are the 5 steps you can take up on your next mortgage renewal to help you annihilate that like button. I mean, annihilate your mortgage. But seriously, annihilate that like button as well. So step number 1, negotiate. This is easily going to save you a few hundred, sometimes even thousands of dollars. You just want to be able to check what's going on in the market, what's available at other banks. But one thing that's really important to keep in mind is that every single mortgage home loan is very different. So some banks might actually favor a lower loan to value ratio. So if you own more percentage on your property, they might give you a low interest rate. If you have a bigger loan size, they might favor that. Or if you have other products like insurance, KiwiSaver, credit card, they might give you a lower interest rate based on that as well. So every bank, every mortgage is slightly different, but there is at least a benchmark that you should be checking. So at least you know that's what you're working against. So it's important to know what the market benchmark is and just sort of ask around and see what the lowest interest rate is at the time. So step number 2 is structure. Now, people always talk about structure and it's a word that gets thrown around a lot. What does it actually mean? Now, real simple, for a new homeowner, you want to be able to utilize your savings against your mortgage using facilities like the offset account and your revolving credit facility. Now, sometimes you might set it up in the beginning of your mortgage journey, but you might not be using it properly. So in your first few years, it pays to just talk to someone who's an expert that's going to help you utilize that structure properly. If you have anything that's on a high interest rate like credit card, Q card, car loans, it's a time for you to consider to whether or not consolidate it against the existing mortgage on a lower interest rate. If you own investment properties, then it might be worth for you to actually check whether or not there is equity in the investment property. Perhaps you can do a restructure where you can shift more of that lending on your own occupied against the investments so you have more tax deductibility. And it's important to check in with your accountant as well. And maybe if you have a few properties, it's worthwhile to reconsider what your equity position is. Get the latest valuations from the bank and see if you can actually free up some of these securities for a rainy day, or perhaps new investment strategies that can utilize different banks. Step number 3 is check how much equity you might have on your property portfolio. Now, even if it's just one property, it's still worthwhile for you to just get the latest bank valuation so you can see what the accessible equity is. This is the amount that the bank is willing to lend you based on how much your property is worth. And reason why you want to do this is because you have more options to make better financial decisions, such as maybe borrowing at 2.5% at the moment and then buying that Tesla stock. Perhaps you could build another minor dwelling in the backyard so you can have more cash flow, or even it may be time for you to start considering buying another investment property. And for a more experienced investor, it is very important that you're always trying to utilize your equity position so you can free up as much equity as possible. So step number 4 is borrowing power. Now that you know what your equity position is and how much you can actually access, you want to know how much you can borrow so you can look at the best strategy to utilize that equity. Now, perhaps you're in a lower cash flow position, you might need to consider higher cash flow properties to really make use of the equity. So understanding your borrowing power, just checking in at least once a year at a minimum is going to really help you make better decisions. And again, options is key. And number 5 is reviewing or setting new financial goals. You should review these at least once a year, if not every month. And there is no better time to do this than when your mortgage is coming up for renewal. And I like to keep this simple, right? You want to at least check what your passive income goal is and then sort of how far you are from it, how much equity you have built up from the properties that you have invested, how much more you need to invest in so that you can hit that passive income goal before you hit that retirement age. And just talking to somebody, making sure that you're still on track is very important. Having an accountability partner is definitely going to help you get there a lot sooner. So how can you apply the 5 steps really easily? Here's one hack that you can use, and that is have a MHQ mortgage advisor on your team. Because if you're an MHQ client, this is what we do with our clients every year up on their renewal. Now, maybe you just can't be bothered with anything except for renewing your mortgage. That is fine as well. But just having someone to prompt you and then actually review all of these things with your mortgage advisor is important. And I know that is going to provide a ton of value long-term for you and really just set you up to hit that financial goal sooner. And because everyone's situation is different, and if your situation is more complex, obviously we will assign a more senior advisor to you, or if it's more simple, we'll make sure that you have a competent advisor that can advise you. Now, going back to the biggest mistake that homeowners make when it comes to mortgage renewal, and this is it. They have savings in their account that is not being utilized against their mortgage. So often they might even have an empty revolving credit account and a savings account, and they're just giving away money to the bank. So it's just really important to review that, have a mortgage advisor on your team just to check that out for you. It's kind of like, hey, you know, you've got your car, you want to get a WOF done, you want to get the mechanics to check it out, just get a mortgage advisor to check out your situation. It's going to save you a lot of money in the long term. Just reviewing that structure could save you tens of thousands of dollars. If you have any questions, do leave a comment below. I always appreciate those. And as always, if you guys want to learn more, we have online mortgage masterclass in the description below that is going to help you annihilate your mortgage a lot sooner. See you guys in the next video.